Welcome to The Owner's Exit, the podcast where business owners learn to plan smarter, exit stronger, and move forward with confidence. In each episode, you'll hear from industry experts, seasoned entrepreneurs, and owners who've successfully navigated their exit. Together, we'll unpack the real stories and proven strategies beyond smooth, successful transitions, and share practical advice for your own exit planning journey. So if you're a founder, entrepreneur, or business owner thinking about what's next, you're in the right place. This is the Owner's Exit Podcast, where we help owners see to, through, and beyond the sale of their business. Joe, thanks for doing this.
No problem.
Yeah, we're real excited about the momentum that we've gathered, and we think you can bring some unique perspective.
Well, I'm happy to share my experience.
Yeah. So Joe Maxwell, he's founded and exited two times. Founded, operated, exited two times, and now he's in the profession of running a fund or multiple funds, and he helps others do the same. And so we've got some questions for you.
Great.
Want to gather some experience. So yeah, thank you.
No problem.
Yeah,
Glad to be here.
Thrilled to have you. So why don't you begin by telling us about the first two that you started and operated?
Sure. No, I moved to Nashville. I'm a native of West Virginia, so moving to Nashville might as well have been New York City. So came here in 1992. We were in a recession in 1990 when I got out of college, which all the internships were canceled. So if you were lucky enough to get like an IBM internship, it was canceled. So, you kind of had to fit to your own. So it was a good time to go back to graduate school. And I've always chased business and always liked it, but I didn't have any technical skills. So I was like, went around, looked at a bunch of graduate schools, and I chose Vanderbilt because of Nashville, not because of Vanderbilt, and which is a very interesting. I saw Nashville as this up-and-coming, interesting city, very welcoming, loved it, eminently livable. Even in the early 90s, I was like, I could see myself here. Like, this is cool. So I actually go to Vanderbilt and was fortunate enough to get exposed to a lot of businesses. Every time anybody wanted a project done, a local business is like, hey, we need some MBA students to do a project, I would raise my hand. And so I got to know the local community. I was in my second year at Vanderbilt, and a great investor, a legend named Bill Spitz. He wrote the book, Get Rich Slowly.
Yeah.
He's an awesome guy.
Yeah.
He was the founder of the distressed security market. He was on the Harvard Endowment Board. He's the chairman of the Common Fund. He was a really good dude. He managed the endowment at Vanderbilt, but he taught a class called securities analysis. And you'd sit in class, and it was really cool. You got to simulate the Vanderbilt endowment, which was fascinating. So you got the portfolio effect. You got to look at everything. You got to look at through the eyes when you have that large of a endowed entity, how Vanderbilt invests their capital. And he put up a page that says, this is my scorecard for Vanderbilt. And it's a shame that the average investor can't have access to this level of objectivity and simplicity when they're looking at their portfolio. So later on, it just struck me, and it was just so simple. It was one page, accumulated returns, but it had trends. It had every question and answer you needed to be able to hold a manager or a strategy accountable. So then later in the class, you were to pick an industry and do an analysis, like you were a security analyst, and you pick an industry, and all these overly confident, overly educated classmates I had were, picking all these industries, and they were talking like automotive or supply chain and how inefficient it was. And I was looking around, I was like, what industry are all these people going to work for? And they were all going into the wealth industry or investment banking or trading or sales and marketing or sales and trading in Wall Street. So I said, these guys are so hubris because they're working in the industry. The margins in wealth management, you could drive a truck through. It's so inefficient. So I took that report. I said, what if the average investor could have an investment scorecard? A third-party, objective, unbiased report and review of their assets that held their managers accountable. Because back then it was stockbrokers, and I would say if you ask the barber if you need a haircut, they're always going to say yeah. So like you ask a broker, how am I doing? Oh, you're killing it. Well, how am I really doing?
Yeah.
And it was fascinating. So I took that and started doing a market analysis, and I started literally doing market research to wealthy people. And I said, what if you could get a report that consolidated all your brokerage statements or your trust statements or all your assets into a single comprehensive report? So that was the genesis of Investment Scorecard. And I thought it was a good enough idea. It was keeping me up at night. I had nothing to lose. I was young, 26 years old. I said, screw it, So I started that company right out of graduate school.
In school?
No, right when I finished, I had another classmate that we were talking about it, and he was the analyst. I was the salesperson. We put it together. It was called Investment Scorecard. We literally, door to door to rich people, consolidated their shoebox of statements, and we would sell this report, all manual, done on Excel.
Was it a one-time report where you would take?
No, I would sell them on the subscription. Of course, I learned about recurring revenue. I had built so many businesses when I was a kid. I was that kid. Always had a. I always had a deal. I always had a deal from like 10 years old. I was rolling up lawn services, rolling up paper delivery, rolling up baseball cards. I mean, I always had a deal going. So I sold a subscription on it. And I said, hey, I could do this for you.
So you went door to door selling subscriptions?
Not door to door, but I did meet rich people, theoretically. And I'd ask them, I'd say, do you have this? They're like, no, I'd love that. And I said, well, $1,000 a year, I'll do this for you. And they're like, done. And I would start getting duplicate copied on their statements from Solomon Brothers, from Smith Barney. And this was the physical duplicate copy where I would get, just like an accountant, I would get the statements mailed to me as an agent. Or an advisor, sub-advisor to the account. And I put this report together. Well, we started selling it and then turned it into, I was obsessed with the internet because it just come out. Yeah. And I was
mid-90s.
In the 90s, early 90s.
No rules, no regulations.
No rules, no regs. Yeah. I found the browsers. I started playing with all these Netscape browsers, and all the early browsers. And I'll never forget when I did my first Google search. I said, this is it. So I said, well, what if we use the internet as our delivery mechanism for these reports? Because we could deliver them to the client. They could pull up a browser. So that was the early days of the software. And then kept going, and it's like, wow, we could be the first kind of investment reporting system on the internet. And we were. So we took it from 1994 and grew it. I think we had $4 trillion in assets on the platform when we sold the business in 2007.
That's wild.
Goodness.
And I mean, it was bootstrapped, started with a credit card, found some investors, turned the investors into more investors, built it, sold the first. I really found the prudent investor rule was starting to come out, and it applied to trust companies. So I went to the trust companies because they had a fiduciary obligation to provide this, and they needed it. So I was able to check the box from a regulatory or soft regulatory infrastructure because the AIMR, which is now the CFA Institute, had published the performance presentation standards. So there was guidelines out there, and we followed them. So then we could hold people accountable to it, and we got into the trust companies because then we could build digital interfaces to the data. So we went from the paper report to the trust company to digital infrastructure, consuming the data. And then we built the business, and we had a back office, and we had a couple hundred employees here in Nashville. And I had offices at the end of the day all over the place. I commuted to New York every week, turned it into a real business. It was fun.
So 2007 you exited.
I tried to sell it. It's a wild story. .com, we were like bigger than most of the companies going public. I mean, we had like
Pets.com.
We had 300 clients.
Yeah.
We had a real business, and like like I'll never forget J.C. Bradford was like, hey, you guys are bigger than a lot of these micro caps we're taking public right now. So I actually went through the process. What if we took it public, got some capital, and really grew it? Market crashed, of course. Yeah. The .bomb hit. I'm like, great.
07, great timing.
I missed that. Yeah. No, that was 2000.
Oh, 2000.
99, 2000. That bomb. So then, went back to the mine, built it again, crushing it. 9/11 hit. I had 25 clients in the towers. 9/11 hit, I thought, oh my gosh, we're done. The world stopped. I mean, for a while. However, all of my clients' data was backed up on our servers, and we were already in the cloud. So our clients were able to, data centers went down in the rumble.
Yeah.
So we were able to turn 9/11 into a massive growth vector because it was the first cloud computing, have your data offsite, centralized data. You just need a browser. You don't have on-prem data storage.
Yeah.
So it was early enterprise kind of SaaS technology. And so we were able to grow from 01 to 07 like a rocket ship. Had a couple interests to buy it, got an offer. They said, we'll give you cash X closing April 7th, 2007, all cash sale, the day before Bear Stearns crashed. So timing was right. Got out of that. So that was the first exit. But it was a wild ride. I mean, I was young, made every mistake on the book. We're very fortunate, had a great team, great culture, attitude over aptitude. I mean, it was awesome. Didn't move the business out of Nashville. Like, we were not a healthcare business. We were a tech business here. There weren't a lot of big tech exits yet in Nashville. Really kept the business here, and Nashville was so good to me to build it here and the team.
So to cycle back, what kind of companies or funds were looking to purchase you, and why did you end up exiting and not saying, well, why don't we continue to grow this and take it public?
That's
down the road?
the greatest question. Everybody was interested. We had an unbelievable business. It was the corporates, the strategics, the large private equity, the growth equity. Everybody loved it.
You were getting offers all the time.
We were getting the offers. We were getting it. So we actually hired a bank and ran a process and all that. When a founder and a team is ready to sell, a business is for sale. There is just a point where
you're tired
and you've taken a lot of capital in, and you've got a huge responsibility. And that's what I tell people all the time. If your number one responsibility is not a return for the investor, you should never take capital. And I had the strain of raising enough capital that, I had to find an exit for these folks. And if you looked at the absolute return, like in hindsight, I should have done a recap and kept it, because it was a business model that kept going and continuing.
Yeah.
However,
you
see where I'm going. In hindsight, it's always crystal
clear. You would have done a lot of things.
Yeah, I would have done a lot of things, but it probably would have been better off, Austin, to get the cash out, pay off the investors, and grow it again with the team. But I'll say, personally, I'd been through dot bomb, 9/11, 07 through 09, and I got to sit out the crisis.
Yeah.
So there's actually, I would have had to rebuild again through 07 to 10. However, we had the winning platform that could have come out and emerged when you look at it, but I just went.
But you would have had to go through.
I just built another one. It was just a lot easier to just go back and take all the knowledge I learned and just go build another one. Yeah. So I was able to take advantage of the next run, but it was under a different brand.
So you sat out in 08?
Sat out. I hung around, helped the company, the buyer, for a year, had my next idea, put the band back together, and we dusted off in the late 08 to start the next one.
And that next idea was?
It was called Shareholder Insight. We noticed that the soft regulation that became hard regulation in the wealth management industry and the fiduciary rules through CFA and all the reporting standards, we noticed that in the 07-09 debacle, there was a lack of transparency in these alt funds. All the mortgage funds, all of the private equity and venture funds, they had a lack of transparency. And because there was so much scrutiny on what happened, a lot of scrutiny, and they earned it gloriously. The PCAOB, which was kind of like the prudent investor rule, came out with some soft standards on reporting venture and private equity funds, and it was called Topic 820. And it was around the valuation methodology of your fund, of your private fund, because it was the Wild Wild West. They were just marking up their funds, raising the next fund. There was not a lot in ILPA, the Limited Partner Association, ILPA came out in partnership with the PCAOB and said, time out. We need to standardize how we don't care how you mark your funds, but it has to be standard every quarter. It was just like money managers used to window dress at the end of the quarter to boost their returns, and there was no time or dollar weighted transparency in the return methodology, which exposes all that, right?
Right.
This was the same thing, and we said, whoa, this is interesting. We've seen this before. There's a trend here. What if we hopped in and built a reporting application that helped do the valuation marks of the underlying portfolios so we could build a portfolio management system, same exact approach, utilizing the same kind of diagnostic data that transactions up with the private companies. So we built Shareholder Insight, and we quickly became the platform.
And that was 2010?
We started building it 8, 9, 10, and then from 2010 to 2014 is when we took off.
And your infrastructure from Investor Scorecard really led a lot of the groundwork to being able to do this second venture.
I would say the learnings,
right?
Knowing how to build enterprise cloud-based native portfolio management software. Yes, we learned everything. But the cool thing was, by the time we had built Scorecard to Shareholder Insight, all of the data models and outsourced AWS and Azure, all these systems had started to build to where we didn't have to build our own. Like at Scorecard, we had to build our own generators. We had to build our own cloud. We had to build our own AWS. It didn't exist.
It was so early.
Yeah. Which, it was a moat. But by the time I built my second one, that moat had already been democratized. Sure. You could go buy shared services. So infrastructure, no, but like the learnings, yes. So we had knowledge that cut years off. So we were able to get back in business. So it took a lot less capital, way less capital, and a lot less time to get to market.
Yeah.
And then you exited that venture in
15. Way early. Yeah, it was a 7-year. I say it takes 7 years regardless. It's a chapter in a business. And you either take 7 years to build the chapter or you do multiple chapters. Yeah. And I always take someone's business, what year are you in? And I'm like, you're up into your second chapter. Someone taught me that. I don't know where I got it, but boy, is it true.
Yeah.
I mean, that's why I say, people do these startups and they're year 2 into it and they say, we're going to sell it in 3 years. I'm like, no, 5. Yeah. You're going to have your first chance to sell it. I don't know. It's probably, there's no data to support it, but.
So this one was more efficient?
Way more efficient. Capital efficient.
So when.
And we knew what we were doing.
Okay. So any regrets on the timing of that exit?
Absolutely not.
No. Okay.
Absolutely not. We sold into a salmon stream that has now become, because if you think about public market investing and you think about T1 and what happened with electronic trading, data liberation, transparency. I mean, you guys know it, the broker-dealer technology now and what you can get your hands on versus 20 years ago, you can't even imagine. Because now you can spin up a small shop in Brentwood, Tennessee, and you have the absolute same tools that Wall Street does. So, wealth investing went from Wall Street to Main Street very easy. But private investing was 100% institutionalized and only institutional, and has not gone to the retail market yet. It's starting to a little bit, but it's taken that long to build the infrastructure. There was no infrastructure for private company investing. It was all analog. It's funds finding a deal, using lawyers, accountants, it's all analog. So we saw the early days of taking PitchBook had just started. Gabbard was a buddy of mine. We were all out there building these tech companies to kind of bring the tech to the private capital market. So when that offer came to us, I knew they were going to use our company as a platform, which is now S&P Private Capital Markets. That business, it's gone from us to IPO to IHS Market to S&P. So if you think of S&P Private Capital Markets, we saw that. That was our engine that built that. One of the pieces that built it.
Yeah.
So you go through this whole learning experience of building this first business, learn a lot, exit right before 2008, start this second business, or more efficient. You build that up, you exit that in 15. But then you kind of do something a little bit different.
Yeah, totally different. And you got to understand, in 08, we bootstrapped, scorecard, raised capital, never had any capital. We had capital, myself, a few partners. So there were a lot of great buying opportunities from 08, 9, 10. I mean, the world was cheap. So we started making investments, and I started putting together these little seed rounds. And, I like to invest. And I saw some things that I was like, wow, this could be a good deal. And price was right. So we put together on the side, angel investing, just typical angel investing, but had some really good hits. And then I had some people that had family offices, had a couple family offices that had backed me in both ventures that came back and said, hey, Joe, have you ever thought of building a fund? You've got access to deal flow. You're the right age at the right time. You're in a market that's in the first inning, fintech. I mean, I remember when it was financial technology before fintech, and a dear friend of mine that coined it, and he runs FT Partners, which is the largest investment banking firm in the industry. We were all buddies. We were all 30-year-old kids building this stuff. So we're all still really good friends. So 2015 hit, and I was like, wow, what if we could take a diversification of folk? Because a lot of the really good small venture capital funds had moved upstream, had raised big money. Because, when I started in 1990, venture capital was not an institutional asset class. I mean, the biggest funds out there were 50, 60 million bucks. I mean, it was a tinkering madman, high risk. The early days, it was the Wild West. It was the Wild West. You didn't get paid.
Yeah.
When you built a company that was venture backed, you got paid in stock. I mean, it was full teams are funded now and they make big money. And I mean, so it wasn't an institutional asset class. In 2000, venture capital in North America was like 86 billion, I think, in the whole market.
Wow.
It's like 190 billion now, and it's growing really fast. So think about that market, because that class wasn't an institutional class. So now it is.
Yeah.
So we saw that, and we said, wow, there's specialized funds were a no-no. It's fascinating. It was all generalist. And I was like, wouldn't a specialized fund make more sense? There were a few out there that had gotten out, but the investors, interestingly enough, saw the return of the early specialized funds, and they said, boy, if you could take operators out of an industry and put them in there with a small fund, the returns are much better, because they have the methodology, experience, knowledge. They have the deal flow, and I'm not trying to look at
the network.
And I'm not trying to be an expert. Like, I don't know how you can be a generalist in venture capital, how you can focus on healthcare regulation one day and financial service regulation the next. I mean,
logistics the next.
It's just so hard.
A huge team to be able to do something.
It's just so hard, and they're not.
And you haven't had that experience and enough success. You haven't had enough time. You can't live that long to have success across those industries.
No. And and you can be really smart, and you can get lucky, and you can look at trends, and you can be a thematic investor and understand a trend. But, it's like you guys, if you're picking a manager, you want someone that's really, really good
at what they do.
They
stay in their lane.
Yep. And so we said, hey, what if we started a fintech-focused fund that does B2B SaaS businesses, and we stick in these regulated industries,
Stuff that you already knew.
Stuff that I already knew where the bodies were buried. I knew the rails, because we had built the rails, and we knew they were going to have to all be wholesale refreshed because of the new technologies. Yeah. We knew that, like, wow, we were building systems going, well, we know if they hit that point, it's they're going to have the refresh.
Yeah.
So that was the impetus to, I had been angel investing, and then I was like, why not? So went out in 2015 and kicked off with a couple partners, FINTOP Capital.
Yeah.
And that's where you are now.
Yeah. And FINTOP stands for Financial Technology Operating Partners. We're all operators. Started that in 2015 as a early stage fintech-focused kind of B2B SaaS software venture capital firm.
So what is the ideal company that FINTOP would look to invest
in? So the ICP that we look for, the ideal profile is product market fit, team. Don't like solopreneurs. I'd much rather see a founding team. In a perfect world, they've been there and done that and worked together before and failed before together. There's all these there's the ideal profile, and then there's the absolute home run that I love. Product market fit, not a huge client concentration. Makes me really nervous because you can build a ICP for a huge client, but it may not scale the flywheel to sell it to a bunch of others. $1 million in a perfect world, if they haven't hit it, but they have lines of sight into $1 million of ARR because they've kind of gotten through all that early adoption. They've had to implement clients. They've had to been through a renewal cycle.
And ARR is?
Annualized recurring revenue.
Okay.
Booked revenue, annualized recurring revenue, the SaaS revenue.
So you're not necessarily concerned with profit right now?
Oh, I've never invested in a profitable company. This is burn. It's an efficient burn.
Yeah.
We look at all the burn multiples. We're really looking for how efficient is their burn. For every dollar they burn, how much revenue are they driving? So you're looking for a burn multiple that's efficient because you need capital in these businesses to grow.
Right.
And we're looking for growth rate, 50+% annual growth rate, perfect world, 100+% annual growth rate. Have some early, generally it's angel investors, seed fund. They've been able to attract a little bit of capital. In a perfect world, they've raised less than $3 million to get to where they are, sub $3 million.
Yeah.
Have a team. Don't really care if they have a board yet. It's not what we help them with, that fiduciary kind of putting the board together, putting the financials. Don't really care about great reporting on the financial side as long as they're building the product and look, they put the dog food out and the dogs are eating it. And that's what we look for.
So you guys obviously come in, provide capital, which is really attractive and helpful for these companies. What else do you do to help provide value to them as they're growing?
Well, we have a network. We have a huge network. So our real value is tapping into our network with leverage distribution. We have about 150 strategic investors for distribution. We have a lot of investors that are actually the firms that buy this stuff. So we act as a screening tool for them. So it's our network, our experience. It's also our ability to put a playbook together. We're going to come in. We're going to mandate, strict reporting requirements, building a board, building out the infrastructure to help them scale. That's our job. To really be partners with these guys. We're minority investors. We never invest as a majority investor. So we're just a partner with these folks. I mean, you got to pick. When we're wrong, it's with strong conviction. And you're not always right. So you're really partner up with these folks for a journey.
Yeah.
What's a deal breaker when you identify someone, they come to you and you're like, no, they've got this, we're done?
I mean, there are a lot of deal breakers that I can see. It's generally, well, of course, there's all the things, the naughties, if they have a tax issue or, all the things, if they have lawsuits or IP that's not clear, those are things that should always be on a disclosure statement as a deal breaker. I think the deal breaker is more the personality and the team. The biggest deal breaker to me is the overconfidence of the founder when they are a bit belligerent in the diligence process. I always ask the question. I'm like, Austin, look, you're doing great. You're killing it, man. We're going to help you go from 1 to 5. And then this business has no problem. It should get to 20 at no problem. But what if you've hit your ceiling, and we had to bring in a team that can help you get there? I mean, you're the largest shareholder. Deal breaker is this. Voss says, absolutely not. I will never be replaced as the CEO. Boom, I'm done.
Ego.
I'm done. I'm out. I don't even care what the business is. I'm out.
You see an ego, you're done.
Yeah. And no, I want an ego, but I want an ego to build teams and business and build the stock price and go conquer the next clients. Because Austin may be a great salesperson, but he could be a horrific operator. But he's sitting there operating a business when I need him on the road closing the next 15 deals. And if that's the the job that sits him best in the company to scale it, but he has to be the CEO. So when people are like, I have to be the CEO, it's really interesting. Negotiating the board, and they want full control to pick the board members. You see all these little things. And generally, they've gotten bad advice from someone that's been burned before. But at the end of the day, you're a fiduciary. You've taken other people's capital, and you're acting like it's your own, and it's not. And so don't raise money. Like, a lot of great businesses out there don't need outside capital. And I'm the first to tell you, when I read a business and I'm like, you do not need a venture capitalist. You need more debt, or you need to just keep doing what you're doing. Like, don't raise capital. So you have to be very honest with that. Raising capital has become the sexy thing, and people love to see it. And heck, there's more founders out there now. They spend more time raising money than they do, running their businesses. So that's a deal breaker. The other deal breaker to me is when I sit down with there's a couple, but I sit down with a team, I'm going through their deck, and then on page 8 or 9 of the deck, it shows my money, and then it shows, and then we'll raise a Series B in 2 years of $30 million, and then we'll go to here. And it's like, you don't know you need that. That could be what we need, but let's make that decision together. Like,
they just think that's the path.
Yeah. And a lot of them have just gotten bad advice, and they're like, oh, thank you for telling me that. Cause man, I was told to put that in there by my accelerator or my growth vector. And they thought you wanted to see that. And so a lot of them are very honest, say, thank you, man. I hated having that in there. And then you're like, wow, these are real people. They just got some bad advice. But the ones that really believe it, I see my money as a bonfire, as a stack of kindling, where they're just burning it to get to the next round. And it's like, you don't know. So those are some deal breakers that are just subtleties for me. Other people, they're different. A deal breaker for me is I like your pitch, and they say, okay, I'm going to send you an NDA. And I'm like, no, I don't sign NDAs. And they're like, what? You won't invest in my business? Nope, I'm out. I just leave. And they're like, oh my gosh. And then they're like, oh, that was, my lawyers told me to have that signed. No, I'll send it to you. Because like, I look at our firm, I don't know how many deals are coming into our firm. It could be 2,000 deals a year. And then I've got some wild-eyed entrepreneur that we invest 2 years later in a business that's adjacent to them. I don't even remember their company. We're not in the business of stealing ideas. It's not what we do. So like, I can't do that. And my investors would kill me.
You can't keep track of it.
I can't keep track.
So to protect yourself, you don't sign an NDA.
I don't sign it. Now, it's different if I'm in a deep diligence process and they want to sign an NDA to look at a client list. I totally respect that. That's 5 steps forward.
Yeah.
But when it's just
it's not front end before you even look at a pitch
look, dude,
deck,
if your idea is that good,
NDA.
your idea must be that good. If you have to protect it like that, I'm like, keep your idea to yourself. I don't want to see it. And it's a learning lesson for a lot of young entrepreneurs.
So speaking of good ideas, could you take us through a past company, how you found them, how you decided to invest, continued to help them grow, and then exited time period later?
Absolutely. I'm going to talk about a young entrepreneur. He's from Canada. His name's Ali Malou. He's just the most incredible entrepreneur. This is a great story. Immigrant family living in Canada. His family had an office supply wholesale distribution company, or retail wholesale, I can't remember. And Ali was the young, educated technologist, went to an technology, I don't even know where he went to school, really smart, went to good school, comes back to work for the family business and says, Dad, we are selling buggy whips. Like, people don't buy office supplies. And literally Dunder Mifflin. He's like, we sell a lot of paper. And he's like, Ali, do not touch our paper sales. That is treasure for the family. That's how that's how we paid for your school and all that. Goose. So Ali, as a smart kid, gets in there and he's like, who the hell buys all this paper? And he realized that their largest clients, by a factor, like 95% of the paper is being bought by hotels. And he's like, why do hotels buy so much paper? Well, the bill that they put under your door at night.
Yep.
You don't see them anymore, right?
Right.
He automated it. The night audit. So hotels in North America have to do the night audit. When they put the bill under your thing, they have night accountants that keep every single bill in filing cabinets for 7 years for the IRS because hotels can launder money because it's a perishable inventory.
Sure.
So you have to keep records of every room that was sold. So he sold all the paper to the hotels, and he automated the night audit. And he used a green initiative with Marriott and Hilton. He moved his company to Bethesda, Maryland, where Hilton and Marriott are. He posted up, and he built a software platform that integrated into the POS and the res management system to automate the night audit and put it into a digital filing cabinet.
Yeah.
Good idea, right?
Makes all the sense in the world.
Yeah. So I was just sitting there, and he couldn't raise any money, and I met him. I met him through one of our investors, and I was like, this is the best idea ever. It's just nobody would choose to print paper if you didn't have to. It's just one of those absolute truths. And it's this hidden business. Well, he got inside the hotel, and he realized that there's 7 different software systems or operating systems. You have a catering management, you have a housekeeping management, you have a property management system, you have a POS, you have a res management system, you have a treasury system, you have a KPI system, and a night billing system. So he built this dashboard, plumbing them all together, and then built a KPI management tool to sell to the management company. Because the typical company that owns a hotel owns 10 of them, or 20, or 40, or 50. You know, when you're at the hotel and it says operated by,
Right. Yeah.
It's not a family or a dude that owns a hotel. It's a sophisticated management company that has investors, and they have, so he built the operating benchmarking dashboard for the owners to look at all their hotels and see how they're operating next to each other by just taking the plumbing out. But he got that idea from the night audit. So that's a company. We invested. COVID hit. He thought he was out of business. Hotels are going to shut down.
Oh, yeah.
He became the only system that could report on what reservations and what the hotel, because they had to shutter so much staff and all that.
Everybody had to get rid of paper.
And they had to get the data back to the owners, because the owners
everything.
had to see where. So he grew a business. We just took off. It was unbelievable.
And you invested what year?
I invested in that business, COVID, whatever, 2020, 2019. We sold it in 2022 for a big multiple.
Yeah.
Because the business, he had all the data. So he who has the data wins. So that's an example of one company. And we've got a lot of those, but that was one that was a fond memory.
What about a company and an investment that didn't go so well?
Oh, wow. So, if you go into my office, we got all our tombstones on the wall, and then we've got this plant with the tombstones, and that's the forest of failure. And it's the tombstones that everybody that comes in, it's a reminder. A lot of people choose to throw away the tombstones that were absolute zeros, but that's our forest of failure, so you can see it. It's a deal I would do again. It's fascinating. It was in the insurance space. They were providing desktop portal access to life insurance salesmen. So when you go in the house, they would take the B2B access, and it had their Salesforce, it had their lockbox, it had their insurance premiums and policies. So you could sit down and give access to your legacy. You know what I mean?
Yeah.
It made sense.
Yeah.
A little bit, it wasn't being sold direct to consumer, but a little probably too much consumer for me, for what we really do. But it made sense. They had a couple really large contracts, and they had the reinsurers. During due diligence, the reinsurers were like, man, we desperately need our carriers to start embracing tech more. They were very nervous about their franchise because insurance is very analog.
Sure.
It wasn't fully digital, and they hadn't digitized the client experience at all. COVID hit, and we thought this business was going to 100x. We're like, oh my gosh, the best thing, here we are in an analog business. They have the digital experience. The insurance carrier's mindset was so scarce. They had such a mindset of scarcity, and they were so new in the client experience. They shut all this stuff down. Instead of giving the agents the tools to do business, they shut them down.
Was it a cost-cutting measure?
Yes. It was cost-cutting. They were scared to death. They didn't know. I think it was cost. it was a business model. They didn't know what to do.
Yeah.
Whereas we had the tool to keep these guys in the living room like, oh my God, what are you doing? Like, and they cut it all down, and we couldn't get anybody's attention. And the business it went from wildly successful to just crashing and burning. So like I said, I would have done the deal again. There was nothing in there that would have ever told me that a pandemic or even whereas banking was forced to transition into a digital distribution model, they accelerated digitization 5 years in a year. Whereas insurance cut it off. Isn't that amazing? Which opened the door for models like Credit Karma and the others to dominate. And it was a really, I thought doing business with the big boys would protect us, and we had a digital transformation strategy, and business was done. I mean, it was 6 months, crash and burn, and it was done. So it was, what would I've done? There's some things I learned, but that was one. There are a couple failures that the writing was on the wall. You usually know it by we have the first board meeting test. Like, you do the due diligence, you get into that first board meeting, and the partners are calling each other going, we missed something. We have one of those where we miss it. Yeah, we did a deal. We did a COVID deal because we always go spend personal time with the company. It's that 24-hour effect. I want to
get a pulse.
You got to get a pulse. You got to hang out, see what kind of people they are, meet their family, see how they treat their staff, see how they treat staff in restaurants. There's all these little things you're testing. We did a deal without on-site due diligence, and it was one of our worst deals. And and honestly, that stuff would have been ferreted about.
Sure.
So yeah, you spend your time with the hardest thing in this business. You end up spending the most time with the companies that need the most help. And if you really spent time with your winners and helped them be bigger winners, it would probably pay better. But it's just your nature as an operator to fight and not give up.
And to fix.
Yeah. Because we're operators.
You're an operator.
We
so
want to fix.
Things.
A lot of VCs just forget, move on. And they're probably right. I mean, when they have large scale allocation models, I get it. But we're fixers. So we actually have a very low loss ratio.
Because you fix the problems.
We fix them. We get them sold. We get our money back if we can. And that's a good deal.
Yeah.
And, I say it all the time, like, a bad deal with good people can be a very good deal.
Yeah.
Sure.
And a good deal with bad people is always a bad deal.
Yeah. Yeah.
Always.
Speaking of deals, we want to talk, because you've got some expertise here, the qualified small business stock.
Yep.
I know that's part of some of your criteria. So can you walk us through from a simple, like,
absolutely,
how to utilize it, how you're utilizing it, and how others can utilize
it?
So
for people who don't know, it's called the QSBS, Qualified Small Business Stock, whatever.
Yeah.
But it's Section 1202 is the reg, the IRS reg. And it has now become permanent law in the IRS law, what's that mean? It could be changed.
That can change.
It was an Obama initiative. It was a very wise initiative that came up to spur investment into small companies. So the original 1202 was you have to be a C Corp. You have to have less than 50 million in assets. You have to invest primary investment stock, not secondary. I can't buy stock. It doesn't qualify. That starts the clock. Okay.
Yeah.
And what it allows you to do, if you hold the asset for 5 years and you get an exit, the first 10 million of personal gain is tax-free.
Or 10x.
No, 10 million.
10 million.
It's
okay.
10 million because depends. It's monetary. They can't say the X because you don't know how much it's going to make.
Right.
It's the first 10 million. The Triple B just ratified the QSBS and made it better, which was shocked because we all were like, we didn't know if Biden was going to continue it, and he did. It's great for the venture capital industry as long as you don't have endowed money. Endowed money is non-tax, so it doesn't matter.
Right.
So 40 Act, pension, endowed money, it doesn't matter. But high net worth,
especially in your space, being primarily fintech companies, totally fintech, there's some industries like ours, like it doesn't qualify, but for companies,
and you're right. Professional service doesn't qualify. Thank you.
Yeah.
Professional service doesn't qualify. Banks don't qualify. There's a lot of non-qual, but the world I live in, and that's why I'm saying QSBS, you got to make sure you're in the qualification space.
Professional services are out.
But manufacturing's in. So there's a lot of, the majority of the businesses, a lot of them really qualify. So you got to know the regs. And don't self-interpret. Get a professional.
Yeah.
Because that's the problem. A lot of people get on the chat or the Google and they self-interpret these laws, and you're like, okay, guys, you may want to really know because there are stress tests and standards, but we know it well. And the cool thing is that your investors love that because you're handing them off big exits that the majority, if not all of their return, because rarely do we have a single LP that makes more than $10 million on one deal. And if I did, I'd love to be. Throw me in that graveyard, but it doesn't exist much. So the new regs are $75 million or less of the asset value of the company. So they upped the value of the company.
And they upped it
to 50 to 75.
50 to 75.
75, and now there's a 3-year hold threshold to get 50% cleared, and they upped it to $15 million. So $7.5 million
for 3 years.
For 3 years, it's 75% for 4 years.
4 years,
and it's 100% for 5 years. So now, our Fund 1 and our liquidity in Fund 2, if we would have had these new regs, would have almost increased a full turn of capital into our MOIC. Which is the return on invested capital, the MOIC.
I think if I was looking at it too, because they just passed this, I think that it also increases with inflation. There's some inflationary.
Oh, are there? There's some bumps in there. I'm not managing to that.
No.
It could be it's so negligent. It's not material generally.
Right. But it keeps you from having to adjust it. 8 years later. It
is probably the best piece of investment legislation in this country because people who invest in private and small companies have done it forever. This allows the market to be much bigger, especially in the world you guys are in. When we see the adoption and the growth of alternative investing and wealth advisory, because what happens is the older baby boomer, they didn't have as the appetite, but the younger generation, they want access to this stuff. They want access, especially AI. There are no public AI companies, and there won't be. So how do you get access to this asset class? How do you get exposure to it? You have to in the alternative markets. You have to invest in the private markets. So think about what's happening now.
Yeah.
It is. You're not going to get that in the public markets, not for a long time.
So for an owner, say they're structured as an LLC or an S Corp, and they see, we've got some growth coming. This might be something we should adopt. Is that where
they're going to have to restructure, redomicile their stock? I don't know. Don't quote me on this, but they have to put investment capital in to restructure to a C Corp. But we don't invest in LLCs or S Corps. Right. We won't. I don't care. We won't do it. You have to
be a C Corp.
You have to recharter to get a C Corp for the capital. It's something worth spending some time to push and look at.
Yeah. That's good.
Yeah. Okay, to switch gears again, I want to talk a little bit about owners who are walking through an exit. Mm-hmm. We talked a little bit on our intro call about what you called PDADs. Talk a little bit about what that means, what an owner's psychology is walking through an exit.
It's I live for the entrepreneur, love them. A lot of owners get smitten with exit, and they get talked in or they go through a process. And I've seen owners sell their business. And someone told me when I sold my first company, they're like, dude, you're going to get PDADs because your energy and all this. And I'm like, PDADs? Like, that sounds awful. Like, what is this? Please tell me.
Is it fatal?
Post-deal adrenaline deficiency syndrome. Mm-hmm. When you're an adrenaline junkie and you're an entrepreneur and you just chase your mind, you can't shut it down, and you've chased and built, and this is and I'm not saying it's your identity, but it's what takes your time, and you sell that thing, and what's going to replace. So you got to really think through that when you're going through an exit. Now, a lot of people are very ready to exit. They're like, dude, when I sold my first company, I've never even been back. I was done. I don't care. People are like, don't you miss it? I was like, yeah, I missed the fun and the people, but like, guys, I knew I was done. Kind of like you with baseball. You know when you're done. You're like, guys, you could call me tomorrow. I'm done. Cleats are hung up. Right. I'm done. Right. I don't care about it anymore. I want to.
But with you exiting that first company, with me exiting baseball, we had something else that we were
exactly. You had something to chase, so you could replace it.
Right.
I see folks. So you really, when you're going through that exit as a business owner, you really got to see what your driver is. Is it for your family? Is it for your health? Is it whatever it may be? I want to exit. Or are you in a business that's got some challenges? That's going to be much better suited to be a part of a bigger company. You got to be very honest about your business. And sometimes it is that where I'm seeing new technologies, you're seeing new entrants, and you're like, dude, I don't have it. I don't have it. Oh, well, we don't have it. We can't sustain. I mean, we're the, you're the tallest small person, it's like you don't have what it takes. You have to sell. Sometimes you have to sell your business. And that's one thing. And that I always respect, go through the process. But a lot of time there's misguided. So you really have to really understand as a business owner when and how and why I'm selling. Because if you have a partner and one partner wants out, buy the partner out. If you're not done, go get the capital to buy your partner out and keep running. Mm-hmm. I see a lot of people sell where one partner doesn't want to sell and one does. And, that you have a misalignment there. So that's, really understanding the psychology of selling your business before you get exit ready. And exit readiness is what I talk about the most, because most people don't realize if you want to sell your business, that's not a 2-month decision. Yeah. Unless you have to, and you got trouble. Right. It's a 2-year process to even start thinking about it, to get ready. Because to do it right. I mean, first off, me included, every bright-eyed entrepreneur thinks their business is worth a whole lot more. It's like your house when you sell a house. Mm-hmm. Market's efficient, and the market's going to tell you what your business is worth at the end of the day. Now, you have to do appropriate market analysis, hire a banker, hire a broker, hire somebody, get a valuation. Yep. But the internal valuation versus the market valuation are very different as well. So I wouldn't spend a lot of money at all
we
on
tell
a
owners
professional valuation.
Real estate. I mean, it's selling a business is just like selling any other thing. It's where a buyer and seller come together at agreed upon price, and that's what the value is.
100%.
Both parties
and the
have
market
to
will dictate.
handshake.
Capital is like water.
It's not the price on Zillow.
It's not the price on Zillow. It's not what the business evaluator said. It's not what you think. It's not what your spouse thinks.
We talk about efficiency of capital. Markets are very efficient. Capital is the most efficient. It's going to the source that needs it the most. So, and markets. And one thing I've been very fortunate in my 2 businesses is the market was giving me premium value for my asset.
You hit it at a good time.
And I hit it. And you got to be very realistic to say, because I've seen a lot of people hold on and the market turn and they just go, oh my gosh.
COVID did that to a lot of folks.
My business I got offers for 5x what I'm getting right now. And sorry, show's over, monkey's dead. Like, move on. Like so you got to be very honest about your business, the market cycle, the new technologies, the changing evolution of the market, the capital, what capital is available to this market. You just got to be very, very honest about it.
Yeah. I was talking to a business owner yesterday. She's built a fantastic business, getting close to 50. She could grow this thing and have
50 years old?
Yeah, 50 years old. Yeah.
Or 50 million. I was
No, 50 years old. But she could grow it like substantially larger if she wanted to. But she said, listen, Austin, I feel like I have all my chips on the table right now. Uh-huh. And if I take them all off, I know I'm going to be okay. And so this is what I want to do. I've got the post all figured out. And this is important to me to go ahead and take these chips off the table. She should
sell her business.
And to get to the next phase, it would require 7 more years.
Well, and
capital.
A lot bigger team.
Bigger debt going on the line. I mean, that's where you got to be really, that's what I talk about those 7-year chapters where if you could be very honest to look at your business and say, hey, I'm doing really well, but if I'm going to scale for another 7 years or another 5 years, this is, you're signing back up.
Right.
Yeah.
Right.
Yeah. And she just wants to take some chips off the table.
And a lot of that is your team. because you're sitting there going, okay, I want to go refresh, rehire. I want to get a new, young, hungry management team to go for the next 5 years. And an owner always knows they can whiff on that.
Yeah.
You could get the wrong team, lose it 2 years. There's a lot in that. It's expensive. It costs a lot of money.
Yeah. There are a lot of variables, team. You could have the economy work against you, some pop-up crazy thing like 9/11, like the dot-com bubble, like COVID. There could be outside variables that step in that impact the valuation of your company that you can't anticipate.
Always. There's external forces. That's why you got to just always live it. Always think of the exit. Always be prepared for the exit. That's what I try to tell. That's what you say. What value do we add to these companies? We get them exit ready. Yeah. We get their books in order. We get their data rooms in order. We get their board decks in order. We get their minutes in order. We get all the things that if someone's going to come do due diligence on my business, they're going to expect that your house is in order. And, I see a lot of companies go out prematurely. They get slapped. They get an offer, and then the deal blows up because of due diligence.
Yeah.
And the best founders in the world go through that, and they're like, never again. That was scary, because I know the next buyer is going to expect the exact same thing. You're not going to find some unsophisticated buyer to give you $50, $100 million for your business and not expect an absolute diagnosis through everything you've ever done. It's just not going to happen.
Right.
And if it is, you're getting bought by terrorist money or something. There's bad money out there,
Sure.
and it's not a reality.
Sure.
So they need to prepare 2 years before.
Two is if you're
Minimum.
if you're not ready, you should start a process. As I say, because it's not realistic to get ready in a year. I said if you sit down with your management team and your board and say, hey guys, let's get ready as if we're going to sell in 2 years. Hire an investment banker to come in. Don't hire them, but have them come in and say, hey, do a diagnostic. What do we need to do? What do you see as our weaknesses? Spend a little money for a little consulting from bankers work for fees too. And they know how to go through this process and get someone that has sold a business in the exact, don't get your buddy and don't get your accountant. Get somebody that has sold an asset in this exact space, because they have perfect information. They know who bid on the last deal and didn't win.
Yeah.
And they can tell you, hey, look, your CAC over LTV is a little short. You got to increase margin. Get your COGS out of this. You don't put implementations in your ARR. Try to get it below the line. There's all these little things you can do because you need 2 years to get your books ready. Yeah. And your financials ready to make sure it's optimal, that when you're selling, it looks exactly like the last exit.
Right.
Yes.
Right.
Yeah.
Right.
Yeah.
Yeah. That's good. Thanks for coming on. This has been a great conversation. Anything else you'd like to add based on what we've talked about?
No, I mean,
any parting words?
My biggest piece of advice from experience is, because I know you're really focusing on getting business owners,
Getting them ready.
And sometimes the answer is, I'm not going to sell. And you know what? Sometimes that's the right answer, because you really got to look at your business and you got to say, okay, here's my business. I've worked this hard. This is the brand. This is what I know, because people know their businesses. And you say, this is how much free cash flow I can create in this business, and I know I can. And I know I can do it for the next 5 to 10 years. And you got to be very honest, because that's what you're getting bought on, is a multiple of that.
Right.
Or you're getting bought on a growth trajectory. There's a couple things that are out there. And you got to be really, really honest to say, if I took a deal right now and I know I could get a multiple of my cash flow that's X, and I get all that cash up front and pay all those taxes, am I better off? Mm-hmm. Or am I better off just operating and continuing the way I am, and then just do a marginal improvement in my margins, my cash flows, my optimization? Because often you're much better off just continuing the way you are, because that same buyer for a good business is going to be there if it's a really good, stable business. So I think it just comes to the psychology. I mean, what are you going to do with all that money?
Your time.
And your time. That's where I go. Now, if you're ready to give back and ready to do something else, you talked about her, she's ready for plan B. That is awesome. When you're ready to go on that next gen, I tell you, what doesn't go well in the super majority of my experiences with an entrepreneur, I'm not talking about someone that inherited a business.
Yeah.
they may want to play golf every day or hunt or fish
Sure.
or go to every national park or whatever. But the entrepreneur who's the founder can't retire. They don't retire. They're into the next. I mean,
it's it's in their blood.
It's a series of passions. Entrepreneurship is never a career. It's never a job. It's a series of passions. And that's what entrepreneurs do.
That's good. A series of passions.
Yeah. And we're destructive people.
They need to find that next passion.
Yes.
We like to say it's a reason to set your alarm in the morning. You've been setting your alarm for a certain reason for the past X amount of years. You finish that transaction, you're going to set the alarm again, and it's not going to be golf. It's not going to be hunting.
Exactly. And I always say,
and your spouse probably knows.
The spouse knows best.
10 days.
The spouse knows best whether you should sell your business,
10
by
days
the way.
Might be the max.
They know best. It's I sold my first company, and I went, and we were remodeling our house. We never had any money to remodel it. And I, like an idiot, became like the GC. And I'm telling you, my spouse fired me. Yeah. She's like, get out. Like, this is like, because I knew nothing about it. I'm taking over. It was no passion. I needed to. And the other thing is that when you sell, it's really tempting to get into, and that's the other piece of advice. Do not, when you get liquidity, hop into the first thing that comes to you or the second.
You need to breathe.
You need to breathe because you're so, the PDADs,
right?
This deficiency is going through, you feel like, and you'll do a bad deal.
The next shiny deal, you're like, oh, that. Or
and you have money, and you didn't have money in your first
Right.
one. So you can make, that is a cocktail for a really bad decision.
Yeah.
Yeah. Well, we know that 73% of all business owners regret selling after 1 year. Now, some of that's monetary.
Is
but
that high?
Yeah, it's
74%. The Exit Planning Institute did a big survey. 74% of all
so it just
within
reinforces
the
everything I'm saying.
Most
Like,
of it's psychological. A lot of people get good deals, get good capital.
It has has nothing to do with the money. They're just
Nothing.
unhappy because they don't know what.
They don't
what
know
am
what
I
to
going
do.
do?
Exactly.
And they used to be the have power, have authority, and now it's
Well, I always say when I interview somebody or talking to a founder, one of my first questions when I'm sitting down with them is always, what gets you up to do 80 miles an hour to get to work? Because we all speed. We all have cars that go too fast. You see what I mean? You can't wait. Like, you're flying.
Right.
And they just go, wow. And then when you sell it, you're like, think about that. You did 80 every morning to get to work. Let's go. And then that goes away. I mean, that's scary.
Yeah, you still have that car.
Yeah.
Yeah, it's a scary. Yeah, exactly.
You'll become GC.
So you'll hop into something that you shouldn't.
Yeah.
And it's not a good decision. And I've actually helped someone that sold their business go buy it back from the buyer before, because he was a friend of mine. He went into such a deep depression, just staring at the walls, like didn't know what to do, and he had made no plan. He just saw the dollar signs.
Yeah.
Mm-hmm.
And wealth has nothing to do with money.
Yeah.
It's so many people. Money helps and is good. You can has a great tool, but wealth, just like a house is not a home. We say all these things.
Sure.
They're cliche, but they're very true.
Yeah. Sure.
Joe, thank you.
No problem. Appreciate it.